Devin, hi, good to have you with us. How have you been?
Thanks, Ashu. I've been great. How have you been?
They've been doing fairly okay, right? I mean, these have been difficult times, but touch wood, I think everything has been safe at work, at home, right? And yeah, I mean, I think this is possibly the new way of life that I think all of us have adopted, right? Also, a little more comfortable than
Yeah,
what we.
yeah, yeah. I wouldn't say comfortable because working from home means like your work actually extends to your home house
Right,
as well.
it does.
Yeah, but I'm sure a lot of people, as an entrepreneur, I feel ki maybe the balance is important, but maybe a lot of people may actually find it comfortable as well. Yeah.
Devin, this is an important conversation, right? I'm looking forward to, right? And this is a conversation. The idea behind this conversation is, you've been on the investment banking side within the startup ecosystem for the longest time, right? You've really come in, you've really seen it come of age, right? You've seen a lot of founder maturity. You've been there long enough, right? And thus, this becomes a very
Absolutely.
interesting conversation. This becomes a very interesting conversation, right? And I think what we'll try and do, and cover under as part of this conversation, essentially is how is that the paradigm of fundraising changed, right? And what are some of the critical things that the founders need to look at, right, when they're looking to raise capital, especially in a post-COVID environment, right? Because this is a very different kind of a market. This is a very different kind of an ecosystem that we've entered in a post-COVID environment, right? But before we do all of that, David, it will be lovely if you could run us through very extensive background that you have in a quick 2 minute roundup, right? I think it'll be easy and interesting.
Sure, sure, sure. Sure. So I'm founder of Dexter Capital. Dexter Capital is essentially an investment bank where
Sure.
we help companies raise capital through primarily institutional investors.
Mhm.
Dexter Capital was set up in 2013, so it's nearly 8 years journey. I break it in two parts: Dexter 1.0, where we were based in Jaipur, focused on tier two, tier three entrepreneur. We
Right.
did a couple of transactions, though getting the fee which happens in success was still tough.
Mhm.
So we pivoted to helping company on tech side, which I've been doing pretty like phenomenally well. We've
Right.
done 40 plus transaction. Our DNA is entrepreneur first. So while I know everybody say that, but literally we work as a virtual co-founder for an entrepreneur,
Mhm.
ensuring that an entrepreneur success is our success.
Right.
That results in multiple things. One, the contracts we have negotiated for entrepreneurs are like pretty good because entrepreneurs are last in line in terms of exit.
Right.
Secondary, our repeat rate has been 100%. Example, one of the company being Dihat, where we done A, B, C, and hopefully we'll close their D as well.
Right.
So that results in a pretty good entrepreneur side satisfaction. We've done 40 plus transaction across all sectors. Last year we did 11 transaction. First half we done only six. Second half, hopefully we should do more than that. We were ranked number 4 last year by Venture Intelligence. We are ranked number 3 in first half. So overall, our journey has been pretty good. Prior to Dexter Capital, quickly covering my background, I was chief financial officer and a core team member with an education firm, raised 100 CR for them.
Mhm.
Also helped the company grew from 7 crore pack to 42.5 crore pack,
Mhm.
from net debt of 35 crore to 100 crore cash and balance sheet. Company gave out dividend of 270 crore after 3 years, like 2013, 2016.
Right.
Prior to that, I was part of a equity fund called Olympus Capital.
Mhm.
Olympus Capital is a marquee equity fund. They invest 60 million to $100 million.
Right.
They were one of the first investors in HDFC Bank way back in 1999. I joined them '07. I exited '11.
Mhm.
It was great experience working with seasoned equity professionals. Before that,
Right.
I worked with a gentleman named Saurabh Mukherjee,
Mhm.
who is, I think, pretty well known. He's founder of Marcellus, CEO of Ambit. He's a mentor, the person who trained me in finance, who actually took me in his fold,
Right.
and a great friend. I graduated from IIT Bombay 2001 to 2005 batch. And more importantly, before getting IIT Bombay, I worked with my father in our small cloth shop in our village for 9 years before getting into IIT and my journey getting transformed.
Very interesting, Devin. That's a phenomenal journey that you've had, right? And I think that motivation, and I think that founder led focus, I think, is extremely important when you're working with founders, right? And I think because I have had many interactions, and I think one thing which is a constant across, I think, each founder is that they're too close to the situation, right, to evaluate certain nuances which are very critical, right? And I think thus it becomes important to have somebody who understands it from an internal operational standpoint, and how the visibility of that business is going to be from an investor standpoint. I think that's a very critical gap that needs to be fulfilled, right?
Yeah,
And I think many founders kind of, go not necessarily wrong, but astray, right? When they're in their journey, of building the company, raising capital, and so forth, right? Devin, basically an offshoot of what you mentioned, right? At Dexter Capital, what are some of the companies that you handle? You mentioned Dehat, right? Which are some of the other companies that you've successfully raised funds for, you successfully advised. If you could give some names, I think that would be helpful to understand the entire ambit of, for example, sectors that you cover under Dexter Capital.
Yeah, sure. So we actually cover all sectors. So we are a sector agnostic firm. I'll quickly mention some of the names for audience benefit. So we advised this agri-tech company called Dehat. We did their Series A, that was in March 19, where Narottam Sexiya Family Office and Omnivore did the round. Then we did Series B, where Sequoia and FMO did the round. Then we did Series C in Jan 21, where Nextburst, now called Process, and RTP did the round. We have advised another company in logistics sector named Picker. Picker, we did Series A from Guild Capital and Omidyar. That was done close to 8 months back. Now, 8 to 9 months back, I would say, in like December 20. Now we have closed the Series B, which is done by Ananta Capital, IFL, and Amicus. Both Dehat and Picker, we were the first sort of advisor to raise capital. In fact, Dehat had been existing 7 years. Picker had been existing for 4-5 years before raising first institution round. Apart from that, in consumer sector, we did like 4-5 deals last year. We advised a company called Nick Ice Cream, which operate on dark store model. It's founded by one of the very iconic or senior entrepreneur who was part of Coca-Cola for multiple years. Apart from that, we advise a company called Pilgrim. So Nick Ice Cream, the round was led by JM Financials. In case of Pilgrim, Pilgrim is personal care space. Pilgrim is founded by one of my IIT Bombay senior, Anurag Kedia. The round was done by Fireside Ventures. Apart from them, in education, we did a company called Thirdflix. It's a team which came from, it's an Indian team, but came from Silicon Valley back to India. The round was done by Xfinity, Honest, and Parampara Capital. So there are like multiple companies, multiple rounds that we advise. We have also worked on M&A side as well. There's a company called SmartQ, which was bought by Compass Group. So overall, I think we've done a fair bit of work across all the sectors. And the way we work, Ashu, two things. A, we generally have a pretty strong sector hypothesis. Sometimes because of the hypothesis, we go wrong as well. Infra market is actually anti-portfolio. So a lot of companies are anti-portfolio to us because we are very, very selective in what we do. We get like 70 plus company a month, and we end up working only 1 or 2. We are trying to hire more and more people. And this shout out to people who are listening to this thing. Anyone who is like senior level VP and above, we are actually looking to hire a lot of people because there is a huge demand that we have for our services. In terms of overall stage, earlier we used to do Series A and Series B. Now we are actually doing pretty aggressively Series A, B, and C and D, which means like 4-5 mil, $200 million. That's a focus stage. I do want to mention, given we're talking about the full spectrum, we also launched a sister concern called Dexter Angels, through which we do smaller checks like 50K to 250K, where we invest in startup. That's not advisory service. We don't charge. The idea is not advisory service, but basically to invest. And we have a private network of 100 plus individuals who are like people who are friends, who are like directly known to us.
Wonderful. Devendra, I'm going to move into, especially COVID, right? I mean, I'm going to jump onto this, right? Because, the ecosystem that existed before, till about 2019 was extremely different, right? We were not necessarily very connected society, right? We still were extremely fragmented, right? So growth was very different, right? Expectation of growth was very different, right? And 2020, and I think first, couple of months, of course, everybody was trying to build a certain, sensibility and thought around, what's going to happen. And I think everybody's waiting to see, how this pans out, right? What's the seriousness of this, right? Because there was, so much of mayhem which was happening in the Western world, but at least in India, we kind of, locked down, irrespective of whether people agree, disagree, whatever, right? I think it kind of contained the entire situation, right? But but I think post the first 2.5, 3 months, right? I think there was clear visibility, right? Technology, was very clearly being viewed as the filler, right? In that gap that existed, right? In a physically disconnected ecosystem, right? And then we saw a huge rush of capital, right? My personal thesis is that there is a lot of homogeneity that came in, right? Because of that, consumers' interaction with technology, right? I think that's number one. So I think influence was clearly established, right, in terms of who's going to get influenced how, right? Second, I think there were trends that were early trends that were setting in, right, which essentially meant that technology is now going to be a very key enabler in whatever we do, right? Be it purchase, be it enterprise related work, right? Be whatever, right? I think it was very very clear. What has been your thesis of it, right? I mean, how has that, in your view, what are some of those things that worked, uh, so much more sharply, right? That the capital moved in very, very quickly, right? And from a founder standpoint as well, right? What needs to be changed in an environment like, the one that we're operating in, right? Because it's far more complex, it's far more dynamic, and the other part of it is that it's also a lot of unknown, right? That we're entering. It becomes complicated, right? So, if you could give me a perspective on that side, right? Given that, as an investment banker, you were dealing with a lot of funds, right? Who've been pouring in the capital. A thesis there is going to be helpful. And second, on the investor, on the founder side, right? In terms of how do they, cut the current situation.
Sure, sure. So I'll give you full overview. So
Mhm.
as soon as the lockdown hit, I've been through at least two cycles,
Mhm.
right? So I've been aware, and in fact, one cycle I was on buy side,
Right.
that
Mhm.
2008 cycle,
Right.
and 2008 we actually worked with a portfolio company as part of Olympus Capital, how they
Mhm.
can survive the pandemic. So I was already aware that how it works.
Right.
And second thing, given I've been part of this ecosystem for 15 years, I was also
Right.
aware that the asset class we are dealing with, which is
Mhm.
equity venture capital, is a long-term asset class, right? So
Right.
as long as your thesis ki the world would survive and what would eventually bounce back, whether it's V-shaped recovery or U-shaped recovery or W-shaped recovery, L-shaped recovery, it doesn't
Right.
matter. Ultimately, it recovers, then things will be fine, right?
Mhm.
So as soon as that happened, two things we ensured: all the companies that we were working with, we ensured that the rounds get closed. For example, we were doing Dihad Series B; it was entering in March,
Mhm.
and when it's happening, we pushed very hard to ensure that we close the round pretty quickly, because
Right.
sometime at some institutional level some uncertainty happened, right? So we
Right.
ensured none of our company got napping, and
Mhm.
we closed all the rounds.
Right.
Now we started interacting with the all the institutional investor. The clear message, even from the largest investor at that time, from I would say 25th March till, let's say, last week of July, was, hey guys, we are not doing any new deals.
Mhm.
We are singularly focused on portfolio company, and which was
Right.
pretty sensible move, right? because
Right.
because operations got shut, suddenly you have a large burn. How do you manage that? The only thing we used to tell these guys, ki, guys, totally understand it. The thesis that we need to define, is it
Mhm.
temporary, is it long term, right?
Mhm.
And most of the people used to agree, ki, hey, it seems temporary, so we should be getting back to deal table
Right.
pretty quickly. That was our thesis. So we did not do anything drastic at our team level like a lot of people did. We did not do anything. We also kept our client also, you can say in some sense, ki, hey guys, just let's wait it out, it will be
Right.
solved. So because
Mhm.
because clients also need that support, right? Ki, hey,
Right.
it will be fine, right? So
Absolutely.
we did that, and we expected that bounce back would happen, which started happening post July, August. And
Right.
the bounce back was pretty sharp.
Right.
In the demand bounce back, at least in funding, it was pretty sharp.
Mhm.
Actually, that was led by the liquidity that got provided by both Indian central government or like world central government.
Right.
What also happened is, wherever that happens, when there's excess liquidity,
Mhm.
sometimes that excess liquidity also flows in to alternative asset class, which we call
Right.
equity venture capital.
Right.
So lot of funds got created. For example, Tiger Global raised the 6.5 billion, and they
Mhm.
got like oversubscribed.
Right.
And people, if they know Tiger typically hunts in like taxes, like if there is a new fund, they would be out to deploy in like 2.5 year, right?
Right.
So as soon as the, you can say, January of this year hit, people saw the frenzied activity by Tiger, and obviously if Tiger is hunting actively, no other fund, whether it's SoftBank or Prosus, other fund have to follow. They cannot be left behind, right?
Mhm.
So the excess liquidity in the market led to, you can say, pretty active deal activity, which we are seeing now, which is like 20 plus unicorn has been created in the first 8 months of the
Right.
2021. And good thing is that activity continued. That activity did not stop. So even Series A, Series B, most of the funds, whether it's Sequoia, Excel, most of the funds created the new funds, which is essential, right? Because once you create the fund, you can deploy for next 3 to 4 years. So the market had ample liquidity. Coming to demand side, you can say, was more sort of, let's say, divided in sectors. So good thing is that after the first lockdown, governments were pretty sensible how to do second lockdown. I know the second wave has been extremely terrible. Nobody saw
Right.
it coming. That was that was unfortunate thing. A lot of people actually got affected in personal level. But good thing is people knew how to deal with it, so they were able to deal with it, and that's where you can say literally economy divided in like two segments: sectors which got badly impacted, like restaurants, etc., where sectors which got positively impacted, which is like gaming, edtech, e-commerce, logistic, etc. Because people are sitting at home. If people are sitting at home, ultimately they need to order, right? So
Right.
now instead of people going to mall or the local markets, now they're ordering from e-commerce, right? So e-commerce actually got a huge this thing. The services which can be delivered by home, which is like urban club, etc., they also got the boost. So overall, you can say anything that was digital got the boost because now digital was driving the economy, right? Because physical suddenly had stopped. And obviously, given digital was driving the economy, digital economy, or you can say all the startups which operate on that, actually got major boost, and that sort of supported also the funding environment as well, right? It's not like this capital was chasing the underlying numbers that these ventures were producing were also phenomenal.
Right.
Plus, what also happened is in the US public market also saw fair bit of boom. We saw Airbnb, where Airbnb also as part of like scare, they raised their first round immediately at the lockdown at a very atrocious terms, right? Like, but as soon as the lockdown was behind, Airbnb actually did an IPO, which was like phenomenal IPO. DoorDash did the IPO. So public tech market were extremely buoyant. We saw all the 10-year back, all the companies which were top 10 market cap were either driven by Petro or Berkshire Hathaway, those kind of things. Now, if you see top 10 market cap company, they are like Apple's or Facebook
All tech
or
companies.
Google or Amazon, right? Tech driven
Right.
companies. So obviously that also give the confidence to public market investor ki, hey, it is time to invest in tech, but tech will dominate the world in coming future. And obviously that sort of also had positive impact in India as well. SEBI was also kind enough to allow even loss-making company to IPO, which could not have done like 2 years back, by ensuring that QIB portion could be like 75%, right? So that paved the IPO, and we already seen like Zomato, which is like not making profit, has done like bumper IPO, and we see more tech
Right.
IPO coming to
Right.
fold as well. So overall, I think activity has been pretty good, both led by demand side, where digital economy doing well, as well as supply side on the liquidity side.
Very interesting. Devin, do you think it's a temporary trend, right? I mean, given the kind of ecosystem that we are, right? I mean, India essentially is a extremely physical economy, right? I mean, touch and feel is very critical, and there are multiple reasons that behind that, right? I mean, we're not, we're still struggling with basic education across many layers, right, of our ecosystem, right? And then that the only alibi to to an environment like that is touch and feel, right? Where you see something and you believe it, right? Or there's a trust ecosystem that you build around it and you consume essentially from that, right? While of course we talk of all of that, right, of all of digital art and so on and so forth, right? There is a huge pullback which is there from, for example, say edtech, right? Now, which has seen a huge participation from, many, larger VC and PE players, come in and, to who have invested in say Byju's, and we've of course seen a flurry of acquisitions that happened in the process, right? So there's been a huge participation. Do you think there is going to be a pullback? I mean, do you think this is an aberration which is not, we'll eventually move into a harmony model, which is going to be that of coexistence, right? And not necessarily a complete shift into digital, right? So what we are seeing right now in terms of, say, the pricing and the liquidity, right, could essentially be an aberration. I mean, what are your thoughts about that?
Uh, Two comments, Ashu. So on demand side, not at all, because had the lockdown only be let's say 15 days or month or 2 months, I could
Sure.
have said that. But lockdown or people sitting at home has been pretty extensive. Now we are in August. Lockdown, first lockdown happened like 20th of March last year, and
Right.
the reason for that is actually tech. Tech is not like hey, you have just put a layer of tech, right? Tech is very transformative. But if I talk about India or any this thing, right, the people are not natural user of tech. At least we Indians have been a forced learner. We have been going to school, then we open the book, then teacher will teach, right? We don't even know how to like learn by ourselves, right? We don't have habit, right? The tech, the beautiful platforms like WhatsApp, Facebook now have made people ki, hey, I can just play it, right? This phone is not going to harm me if I just play it, if I do mistakes, right? So people
Right.
have learned, right? People learn to order, people learn this thing. Let me give an example. Some of the things have been so convenient, right? Let me give a very small example.
Right.
If I take let's say case study of saloon, what earlier people would go to saloon, stylist would come to saloon and then would work, right? What
Right.
what urban clap has done? Urban is transformed. Hey, you can have service at home, which is more convenient. Now stylist will come at home, right? So stylist doesn't need to be dependent on a guy who has money to provide infrastructure, who has money to put capex to open saloon, right? Any stylist can become micro entrepreneur, right? It doesn't need a guy who would give a job, right? So those kind of things have been transformative, which is like more a democratizing kind of thing. And they would happen. A lot of people who never ordered from you can say e-commerce. Now they're ordering and they're finding the experience lovely. Hey, I can order anything.
Mm-hmm.
I can actually choose, right? So those are the things which are actually phenomenal. You can say from that side. So I think the demand side it's going to stay. Some of the sectors which were badly impacted. I talk about one of the sector which is pretty close, co-working. I am one of the co-founders of a company called Insta Office. Co-working sector got badly hit, right? Because offices are closed, people won't come, right? In those kind of sectors, you can say the hybrid is likely to. So people will say, ki, hey, given we've been working from home efficiently, we can continue to work, but companies may want the employees to come. The likely solution, the likely friction where it is likely to settle between owners of the company, entrepreneurs, and the employees, ki, hey, hybrid is going to be, right? So there will be office, there will be people who will be working from home, and the people who will be working nearby their home, right? So that's the kind of thing. So I think the new paradigm would be some sectors would have changed habits permanently, and those habits will continue. So I don't think there would be any demand aberration. Some sectors which are like, let's say for edtech, which were focused on academic side of it, because schools were shut, that might sort of, let's say, have some impact, because once the schools open, academic may not people like kids may not be focused on academic, right? Why a kid would want to study 2 times, but the co-curricular other things may still continue, right? So it could be sectorial sort of thing, but largely I think the habit change is permanent. On the capital side, I do think there might be some sanity. The sanity is not like capital would sort of go away. It's just like any sort of bull run is always followed by either slight small correction or large correction. My expectation is like people will feel ki, hey, it's time, we enjoyed a bull run. Let's take some sort of profit, etc. And that
Right.
might have some sort of, let's say, balancing act. Or you cannot like Sensex is 57,000, right?
Right.
Can you predict Sensex go to 1 lakh? It's pretty hard, right? Because companies are trading at like phenomenal multiples already, right? So
Right.
those kind of things could happen where you can see small sort of correction, and sometimes those corrections get driven by geopolitical event or economic event, right? So right now, the way things are happening in Afghanistan, though there's nothing like there's no world intervention likely to happen as of now, the way we are seeing things, but
Right.
some geopolitical event can impact, right? Because fear is enemy of a bull market. Or right now, neither Indian central bank or a US central bank is absolutely not caring about inflation, while inflation is pretty high, right? Once they that hey, economy is bounce back, we are behind, we are completely up, they might start targeting inflation, which means interest rates start going up, which means the cheap money which has been flowing to stock market or the private companies start sort of going to bonds or the asset class, and that could sort of also see the corrections, right? Those kind of things happen. My expectation is till December, nothing sort of happen, but just post December, we might see bit of sanity coming to the markets.
Right. I have many points, right, on some of the points that you highlighted, right, especially on liquidity and so on and so forth. Right? I think we're amid a very complicated situation. So I don't personally, I don't see that happening, right, anytime soon. I think it's a, it's going to be I mean, there are inflationary pressures, but I think they'll have to possibly be tackled with status quo, right, and not necessarily by an upward movement of interest rate, right, because that's something which is going to kill us. I think we need more capital right now, and I think availability of capital at the right price, I think, is very critical. Not just
Ashu, I hope you're not leveraging to invest in stock market. That's the only thing.
no, I'm not. I'm actually on the cautious side, right? I'm on the cautious side of things. I'm just waiting and watching for many things. But just a quick point, right? I mean, you highlighted about urban clap, David, right? And a very interesting example. And I have been a customer, right, and a user. And trust you me, I want to go back to the salon. And I'm being very honest with you, right? And that is not because the experience is very different, right? And that's what my fear is, right? That there are certain activities that are getting funded under the anticipation that this is a personal, permanent shift, right? Which might not necessarily be the case, like you highlighted in co-work, right? And I think that's a very real way of evaluating a situation, saying that, we're possibly 50, 60% clarity. We don't know 100% how it's going to play out, but this is going to coexist, right? And thus it becomes a good possibility for co-working. But I mean, what scares me is the large valuation. But I think that's a discussion for a different time, right? And we're going to keep it at that. Devin, one thing that has happened, right? And that happens in a more mature ecosystem, and I think we've kind of matured as an ecosystem, right? Is essentially, the founder side expectations change, right? Today, investors are seeking a lot more from the founders, right? I think we are clearly off the age where we were funding the 22-year-olds, right? Which was the narrative that we were building, right? I mean, there was, I think we're clearly away from that now, right? I think a lot of seasoned guys are now picking up business, they're doing businesses and so on and so forth, right? How has COVID like event impacted the expectation of investors from founders, right? Is the expectation of more maturity more depth in understanding the market, prioritizing it right, using capital efficiently? How is the expectation change?
If you talk about private markets, I think the investors' expectation. So I'm not too sure understand this thing. Like venture capital game for a yeah, venture capital game for a GP. And I was talking to an investor just yesterday, right?
Mhm.
And the investor was part of family office, right? So
Right.
and earlier the investor was part of venture capital, right?
Sure.
So they say, okay, look, the big difference between being running a venture capital fund versus a family office, right? Family office is our own money. We are like the person who's underwriting his own money. In a venture capital, you're underwriting LP's money. So risk appetite or the way we do the deal is very different, right?
Correct.
So venture capital would chase venture capital would chase those 100x and 20x and 50x return, right? And
Right.
they come via chasing growth.
Mhm.
If you take any company, right,
Right.
they have delivered superlative returns when the company has become market leaders. The
Mhm.
competition is either doesn't exist or the competition is it's significant small, right? So at a venture capital, their expectation from founders will always to chase growth
Mhm.
uh, till the portfolio company achieve the market leader position or a dominant position.
Mhm.
Sometimes you achieve a market leader position, but you don't achieve a dominant position in the sector.
Right.
So they would want to achieve both.
Mhm.
It's not that it would be unwise to say that they don't care about profitability,
Mhm.
but venture capital can bring pots of capital in a company when they know ki, hey, my objective right now is to win the market. Okay.
Mhm.
And they will say ki, hey, I'm okay to have 10 years of losses and make all my profit at 11th year and their own words, right?
Mhm.
So that whole paradigm actually had changed from that perspective. So
Mhm.
my thing is that venture capital would increasingly seek their founder to be more bold, more audacious, and that would also happen because there are more examples for the entrepreneur running that people who just build company have been more audacious, right?
Right.
So that would happen from venture capital side. On public market would operate differently. Public market, we are seeing tech companies doing pretty well in US, and public market we are seeing tech companies doing pretty well right now in India. But public market, the benchmark is every quarter. Venture capital benchmark is like, hey, you do 2 year later, that's okay, right? So
Mhm.
public markets, company which list to public market would be a lot more under pressure to deliver profitability, and basically that might sometimes constrain them to aggressively chase market share at the cost of profitability. So I
Right.
think these two paradigms should operate slightly differently. That's sort of my opinion. And because of that, some company actually may choose to stay private longer, slightly longer as well than required. So that the way this thing operate. Having said that, capital would be available in plenty to entrepreneurs,
Mhm.
for entrepreneurs to experiment, for entrepreneurs to build something. For example, just take an example of Bhavesh, who is my IIT Bombay alum, my hostel junior, right?
Mhm.
So earlier factories were built by industrialists like
Right.
Tata's, Birlas, right? They were not being built by young age entrepreneurs, right?
Mhm.
Today we see the world class. I'm not too sure you've seen the teaser that Bhavish released. It's an
We did.
iconic teaser, right? Literally this thing, right? So a factory which is literally the world class, which was like the one of the largest capacity in the world, had been released, and Bhavish saying, hey, in 2025, if you guys don't innovate, he's like literally challenging heroes and Bajaj. If you don't innovate, right, I might put you guys out of business. That has
Right.
never happened. A young entrepreneur coming and challenging the largest industries, right?
Right.
So that happened purely in venture capital, right? Ola Electric could raise capital, Bhavish raised capital from SoftBank, etc. So those kind of things I think would happen more and more going forward. People who have built, if you see seed rounds, right? If you see seed rounds, 5 or 10 rounds of the seed round has happened more than $20 million capital. That's huge. That's
Right.
insane, right? Those are the things we are happening where capital is chasing high quality entrepreneurs to build businesses ground up.
Mhm.
Even if some of those fail, I don't think this capital will stop.
Right. That's exactly what my point is, right? I mean, how has COVID changed that mindset? I mean, for example, Ola in an ideal condition in a 2000, a pre-2020 environment, right, would essentially been building, Ola across India, many, many other cities that are there, they would have possibly been expanding in that current format, right, abroad. And from that to now, getting into a two-wheeler play where you're building, a very large factory setup and something which is not necessarily part of the larger agenda that they had, right? Do you think it's kind of changed the entire setting? And it's founders need to sort of look at it in a very different way, right? And the expectation from founders, like I asked in my earlier question, right? The expectation from the founders is now kind of it's going to be very different environment like that, right? Because now it's the new, right? that we're going to be kind of catering to, right? It's going to be more focused towards sustainability and so on and so forth, right? So is the expectation from founders, is the expectation from business models going to be different in a post 2020 environment, right? Is what I'm more particularly talking about the primary markets environment, right? Which is essentially venture capital funded, right? Angel funded. That's essentially the environment that I'm particularly talking about, right? So is the expectation from business models and founders going to be different in a post 2020 kind of environment? What's your thought about that?
I would say primary market would certainly operate slightly differently than the secondary, unlisted market.
Right.
Though having said that, if you see that the way IPO is happening, 75% is reserved for QIB, and QIB is nothing but
Right.
more mature investor. So I
Mhm.
think these entrepreneurs would have decent leeway. I would say, let's say that decent leeway could mean like at least 1 year or 18 months to 24 months.
Right.
Yeah, but in those 24 months, these entrepreneurs would need to prove the profitability.
Mhm.
If and there are different metric will come. The analyst world is very smart. I have been an equity analyst, right? So you
Right.
always figure out how to figure out the company's core, right? So it may come across ki, hey, EBITDA is negative, but core profitability is positive, right? So people will figure out, hey, in these markets where market leadership is received, so core profit is there, but if the companies are profitable, so this is fine, right? And that could be perfectly fine, right? Amazon has been operating like at negative profitability, but Amazon at core level has been always profitable because they
Sure.
always reinvested their profits very, very aggressively, right?
Right.
So those kind of things can emerge. Having said that, because of this quarterly calls, etc., where out of 15 investor, 15 analysts, right, you get two analysts who would hard tough question, and
Right.
those would have some impact on subconscious mind, right? Entrepreneurs are human; they cannot be immune to the criticism that comes to this thing, right? So I think public market entrepreneur who list to public market are likely to be more sanguine compared to the private counterparts.
Interesting. I'm actually itching to ask you a Zomato question, but I'll possibly reserve it for towards the end of our conversation, right? But my essentially a follow up question, Devendra, right? Is that I mean, we've changed as an environment, right? I mean, my thesis personally is that given that we are now consuming from essentially the same medium, right? And that's not just true for you and me, but that's true for a larger country, right? I mean, Geo's kind of enabled, and this is kind of cliche, right? But I mean, Geo's enabled cheap data. People are consuming content. There's a very different kind of an influence, right? Arbitrage between market and market B is kind of gone down, right? And we're essentially moving to a homogeneous environment, right? Which is also leading into this, the influx of capital, right, into a more predictable environment, right? And that's essentially what I think is kind of really driving it, right? So, and my sense is, even when you are say while you are anticipating X, right, or say in a current situation, you're comfortable with a 90% or zero point 0.9 of X, right? An environment like that. And I think that's essentially how possibly funds are also factored this in, right? From a performance standpoint. My question is, for many startups that are now coming up, right? Or essentially, in an early stage right now, which will possibly be in a seed, pre-series, a series, a sort of a category, right? Uh, how important has become to solve for a very, very clear problem, right? Right, in an environment which is very, very homogeneous, right? Because in a dynamic environment setting, you really can't solve for two or three problems, right? I mean, that was always true, right? But you always had an arbitrage, like I said, between a market A and a market B, right? Between a customer in a market tier A market and a tier B market, right? But that's kind of reduced. How important does it become for a founder to define the problem that he or she is solving very, very, very clearly, right? And not really sort of spread themselves thin across a two or three solutions, right? Which could mean that they lose out to competition, which is aiming for excellence in that a particular category. What is your thought about that?
Extremely critical.
Right.
If a founder has not done his homework in the kind of market they're launching or the customer problem that they're launching, it's extremely difficult. And one of the things, Ashu, that clearly emerges when founder pitches to the investor.
Sure.
At Dexter, we are one of the investment bank who pushes our founders to build financial model and pitch decks.
Right.
And founder question, hey, you are there to help me, right? You are there to
Right.
you are the investment banker. Your job was to build a pitch deck and investment
Right.
the investment memorandum, right? Why the hell you're talking and you are like this thing? And I tell them back, right? You guys, I've done this 40 times. My
Right.
biggest challenge is not like the way you're building, the way you're presenting, right? And
Right.
you are telling something which is different than the number reflect, right? The people ask LTV to CAC, you don't even know how to calculate LTV to CAC. You don't
Right.
know the codes, right? That's not acceptable.
Right.
So I want you to grind along with me to build that thing so that you know that you have clarity, right? When you sit in front of an investor who is more knowledgeable than, because he has seen not only your pitch deck but your competitors' pitch deck as well, right? So it's better you top of the number. You know what your competition is doing, right?
Right.
Extremely important, Ashu. This is like one of the hallmark of great entrepreneurs. Great entrepreneurs do extensive amount of research. They know what the customer want. They sometimes even know beyond what the customer want,
Right.
right? Like iconic Steve Jobs of Apple, right?
Right.
So sometimes you build product which you know that customer would love, and I think that's a absolutely needed. So if an entrepreneur is building any company without having clarity about vision, it's likely to doom, right? So this is going to be always a critical requirement now and also in future as well.
Interesting. Devin, I have a question around velocity, right? I mean, I think, when we talk of venture capital ecosystem, and I think, this is something that I'm sure you've also addressed, I've also addressed in multiple locations and many, many times, right? Is essentially that, there's a huge question mark around the profitability of startups, right? And I think in the traditional ecosystem, people don't tend to understand the fact that, as, one is prioritizing for building a market level engagement, right? A customer level engagement and a thick engagement, right? Which is very consistent in nature, very predictable, right? And then comes the possibility of monetizing that engagement, right? At a later point. Now, typically what happened in a pre-2020 environment, right, was, our velocity was very different, right? Our market acquisition was very different because we were a fragmented ecosystem, right? And this is very India specific problem, right? And like I discussed, right, in my earlier point, we've kind of now changed, right? We're now in a very, I wouldn't say completely, but a very predictable environment, right? Where you can target the customer basis what he or she is watching. You can understand their preferences better. Has the expectation from the investor side changed on the velocity of market acquisition, right? Earlier, where they could possibly give you 2 years, 3 years, right, to get to a certain point, has that expectation changed? Is the expectation shifted from saying that your 36-month goal has to now be achieved in say 18 months, 20 months, 24 months, right? Or is this a more founder side sensitivity that has to be now kind of demonstrated, right? When you're actually going out and raising capital, think that, listen, now this is a very visible ecosystem. We can actually done doing A, B, C, D things. We can acquire this market faster, right? I mean, how is this particular point being discussed, right, in these conversations? And this is a very, very important point. I mean, at the end of the day, everybody's chasing a large market, right? How is this point being discussed in these conversations?
I would say there is a clear cut expectation that how quickly you can acquire market. And I know
Mm-hmm.
sometimes it comes at the cost of profitability.
Mm-hmm.
But investors are also completely aware about profitability. And profitability defines, like while in traditional sense, profitability is looked at EBITDA level profitability.
Right.
But in our world, investor world, profitability look multiple level, like GM level profitability, CM1, CM2, CM3, right?
Right.
There are different metric, and I think
Right.
there's a separate session needed to explain what all those metrics are,
Right.
Ashu, right? I would say at GM level profitability, investors abhor that. They don't like it. Hey, you are burning where you're actually negative at GM level. But
Right.
sometimes people have done that just to penetrate in the market, just to change the habits, and they have been okay with that because they feel
Mm-hmm.
key and the way if there is a GM level negative this thing, people would look at LTV to CAC, right? If I acquire a customer, if the customer come 10 times to me, whether the cost I spent to acquire the customer, whether that will justify that, right? That
Mm-hmm.
metric is looked at. If LTV to CAC is not sufficient, then it obviously become difficult.
Mm-hmm.
Overall expectation is, hey, rather than become small, can you become larger? Can you become the faster? That's clear expectation. While there's no guarantee that capital would always be available, right? Because investors are also need to be smart about not throwing good money after bad money. But despite not being guaranteed, there is a kind of assurance that investor provide. Hey, if you do well, right? If you do well, you would get capital from alternate sources. Sometimes you'll get capital from us as well, right? So people do push the founders to achieve, you can say, crazy metrics, and
Mm-hmm.
and that sometimes reflects in terms of follow-on funding happening pretty quickly at higher and higher valuation.
Right.
And I think that will continue to happen at least in foreseeable future, in my opinion.
Right. But then, follow-on funding is not even, I mean, you're doing possibly just about 5, 7, 10% of what's expected out of you. Follow-on funding is happening, right, in today's environment. I mean, a company raising capital, say, for example, in January, the next round of funding is essentially happening in the month of July and August, right? I mean, nobody's waiting for it. I mean, there is pressure to very quickly deploy, right? Without it not going through that cycle. I mean, how do you read that?
Yeah, so look, there are two phenomena. That's one, market participants have become larger.
Right.
So earlier, let's say market participant X, now that X has actually become 5X or much more, and that's likely, right?
Right.
If you see in US or China ecosystem, they have been much
Right.
larger than us, right?
Mm-hmm.
So given China is now closed for tech investment foreseeable future, given
Right.
the regulatory guys have come pretty hard on the tech company, right? So that would
Right.
shift, right? So because of that. Second is also FOMO, right? FOMO is like people say, ki, hey, I want a piece of this company, right? And that's a luxury, right? That's a privilege. Earlier privilege was for an entrepreneur, ki, hey, I want somebody like SoftBank and Tiger as part of my cap table. And now, very quickly, the privilege is shifted to entrepreneur, right? Now, an investor has to say, hey, I want the privilege, where I want to be part of this likely host, which is going to be unicorn next year, or like 6 months, right? So I think that's a dynamics change, right? And the dynamics would continue to evolve, right? This would continue to evolve. So once entrepreneur, who's entrepreneur, right? Entrepreneur is somebody building company, right? If you tell a young guy, hey, why don't you build aggressively? Capital is going to be available. Why he would hold back? He would actually come to the market. He will say, hey, I'll give BMWs to give you to hire you guys, right? So entrepreneur wouldn't hesitate because now they are being told, right? They are being cautious.
Interesting. Devin, you mentioned something about LTV to CAC, right? I mean, and that's something that I was in a very interesting conversation, right? And where one gentleman, and he mentioned that at the end of the day, there are investors who are investing, there are founders who are raising capital, creating value, but by the end of it, all of it is getting spent in just about two or three environments, which is that of, say, Facebook and Google, right? At the end of the day, they are the winners of all of what is happening, right? This entire liquidity event, right? Now, but that's in a lighter note, right? But what is happening, Devendra, is essentially that and this is something which was being discussed across many other forums as well, right? Is that the cost of acquisition is going through the roof, right? And then that essentially means in a higher liquidity environment, right? And that essentially means that your the CAC to LTV ratio, that which is a very critical metric that is kind of evaluated across, I think, all the rounds, right? When you're kind of raising capital, you're looking at that variances and movements, right, around that particular ratio. What happens to that, right? I mean, how is or has this been parked for a bit, saying that let's not talk about this, we'll possibly look at it in a different or a different day. But what's happening to that? I mean, when the cost of acquisition is going through the roof, right? I mean, at the end of the day, everybody's in the same environment chasing the same customer, right? Which is also a huge problem with a connected ecosystem, right? How do you read that? I mean, how is that being read in the conversation, and how's the expectation on that being changed?
Actually, this is very, very interesting. And I know Google and Facebook have an extremely dominant position.
Sure.
But just for sake of all sort of venture capital, because you're very right, a large part of venture capital money just
Right.
flows back to Google and Facebook and kind of those things, right? So it is interesting thing. You can say, I mean, I would say, ki, hey, if there are possibilities where people can say, actually see, ki, hey, why don't you build alternative Google and Facebook, and even they don't make money, it's actually they will make money, right? Because they would, in other portfolio, their CAC probably would become lesser, but maybe it's not easy as well, right? The simple sort of answer is, look, when the ecosystem doesn't see an immediate solution, right? It's very hard to build long-term solution, right? At least venture capitals are not geared to that. Otherwise, they would not be venture capitalists. They would be entrepreneurs. Okay,
Right.
they are the no offense to any of my venture capital friends here. Okay, they are the people who love to solve easy problem. Entrepreneurs are there to solve the hard problem, right? So the solution for them is, hey, rather than trying to build the next Google or Facebook, which can reduce the CAC for my entire portfolio, they would say it's probably easier to go to LPs and ask for more money and let it support, right?
Right.
I think entrepreneur would be smart. They would probably figure out alternate channels. Ki, hey, this is my peak CAC, and beyond that, I don't want to go, right? And that sort of would continue to happen. Obviously, if somebody offers them lower CAC, entrepreneur would take it from both hands, and that's where people who are smarter entrepreneurs who ensure that the CACs are on downward trajectory with scale, etc. Or they have visibility, right? They know what we are doing, and we are doing with the same hand, right? They would ultimately sort of, let's say, win. So I think that equation would set in somewhere where it is expectation on entrepreneur, what kind of CAC I would want to underwrite for my business and how long. Those kind of things I would sort of operate.
But are you essentially saying, Devin, that this is a temporary trend, right? I mean, everybody's kind of looking at this as a temporary phase, right? That this excess liquidity, everybody's chasing in the same environment. That's possibly the reason there's a higher CAC, right? But eventually it will normalize. I mean, is that the thought process?
So I would say capital would be available in plenty, but the kind of liquidity that's available now, that could be temporary. My expectation is, once Tiger has deployed its fund fully, which could happen by December or March, I would say this frenzy should come down, because one activity definitely leads is one guy is aggressively doing it, right? You're not expected to stop it, right? So if Tiger is doing it, then everybody else, SoftBank, Falconers,
Right.
ADQ, Prosos, Temasek, everybody has to follow. I
Right.
think once that activity sort of becomes lesser,
Mm-hmm.
I'm sure more sanity would prevail, but the capital would be available in plenty because there would be more exits by then. People have made more money. They would be happier with this asset class, alternate asset class. So there should be more money. But yes, frenzy would stop and liquidity would become slightly lesser compared to what we are seeing right now.
Interesting. Devin, one thing which is of course, something that, and the good part is, both you and me, we've been across, both the legs of the ecosystem. I mean, this is both the time zones, right? So, which was like until about a pre-2020 and, and a post-2020. And I think we kind of now entering this with reasonable amount of experience, right? One thing which is very, very common, right? And this is essentially an offshoot of, the LTV and, CAC that we spoke about, right? Is essentially the traction, right? Now, in earlier ecosystem, right? I mean, everybody, given the complexity that we had as an economy, right? I mean, everybody wanted to sort of understand that traction much better, right? I mean, they would typically, land up dissecting it in many, many ways, right? Looking at regionality, savings base, right? Preconceived buying patterns, so many other things, right? I mean, there's so much of science to that, right? Today, that is kind of changed, right? How's traction being looked at? I mean, we are seeing a lot more money getting poured in just about a very small reflection. So you don't, for example, you have like 100, 150 customers, 200 customers, early stage investors is what I'm talking about, right? And there is a large round of funding that you can raise, right? I was recently in a conversation where the founder has just about, good enterprise tech, right? About 30, 40, 50 customers, early phase. They've raised money in, a couple of $1 million, right? I mean, they've raised at a valuation a couple of $1 million, right? It's bizarre, right? Something it didn't sort of expect. I mean, I understand there's liquidity as a concern, right? But what's leading into that? I mean, are people buying early traction as a reflection of what it potentially could be, without necessarily looking at the complexities? I mean, what's changed in this just about a year's time?
One comment, Ashu. $2 million valuation for early stage company, which is a traction, is not bizarre.
No, this was higher.
It's actually I'm seeing a lot more entrepreneurs who are coming who are pre-revenue, no traction, and they're saying,
Right.
hey, we want 3 or 4 million valuation.
Uh-huh.
Look, if you see this whole venture capital model, right, it's
Right.
nothing but I'm a Marwadi. I'll call it a Marwadi style business model, right?
Mm-hmm.
You are a young entrepreneur, a guy who turns 2025.
Right.
Boss, तेरे को धंधा करना है. धंधे was capital नहीं, I'll give you capital. The entire Tata group was a venture capital model, right? Because now the factions are fighting. They provided
Right.
capital, right? Tatas were entrepreneurs, and there were people who provided capital, right?
Mm-hmm.
So essentially, what is happening, right? People are providing capital. Now, only thing is, entrepreneurs being more demanding. Hey, I'm the guy who's creating value, right? So why the hell I
Right.
should settle for lesser, right?
Right.
I would want to own higher equity at the end of the game, right? When ultimately it's time for me to collect my payback, right?
Right.
So that's sort of happening. Uh, I would say right now it is a function of demand supply. It's just not too many people may ask actually higher sort of valuation. How long it will sustain honestly would depend,
Mm-hmm.
because it's not necessarily this kind of frenzy can also sustain. I completely agree with that,
Right.
because when the late stage markets are heated, it flows down to Series C, Series B, Series A, and the angel investing as well,
Mm-hmm.
right? So you can say traction is a driver of fundraising itself. Traction is also a driver of, let's say, valuation.
Mm-hmm.
Companies having better traction would definitely drive higher valuation, because more capital chasing the same company. So I think that's likely to happen.
Interesting. And Devin, how's competition being treated, right? I mean, typically, it became very important. You come from you operate in the secondary markets. I mean, you've been on the equity analyst, you've been an equity analyst, right? You've been through that. I've done a little bit of that work, right? Competition becomes very important, right? I mean, there are very key parameters that you would compare across each player within that category, right? That used to happen. I mean, that continues to happen, right? Even now, but it's become very bleak, right? In an environment like this, I mean, it's very difficult to predict, with kind of, the kind of funding which is flowing in, right? It's very difficult to predict, how is the competition going to sit, right? I mean, of course, you have certain parameters like, say, for example, cost of acquisition, what's the potential LTV, right? I mean, there are certain predictable parameters, but it's still become very, very difficult to understand competition, right? How complex has that become in an event like this, right? Where everybody's kind of, given the right team, given, say, early traction, a lot of people are raising capital, right? How, how do you see that, right? I mean, how important or how complex has, understanding competition become in an environment like this?
I think people often underestimate competition quite a lot.
Sure.
You are very right to hit sort of this point.
Mm-hmm.
And the people undermine the competition till it becomes sizable. Let's just put
Sure.
it this way. They're sort of dismissive, etc. And we've seen it. Let's say take about two-wheeler market, right?
Mm-hmm.
Bajaj Bajaj or let's say Bajaj or Heroes would not think
Right.
Bhavish is a competition, but it is a competition. It will vie
Right.
for the same customer pocket today, right? I'll take an example. It,
And COVID did that, by the way.
I'll take an example, a company called Dihat, right? Company
Sure.
Dihat, 3 years back, it was not a competition to boost an agritech player. The company
Right.
Dihat would become the largest, one of the largest agritech player, right? And
Right.
it would be considered a serious competition, right?
Mm-hmm.
So I think the entrepreneur need to be sanguine about recognizing competition early.
Mm-hmm.
I think they need to figure out which entrepreneurs are strong enough to become a formidable threat for them in
Right.
foreseeable, right? So that's where I think they will need to say, and competition, rather than trying to figure out, hey, I can just let's say do away the competition. I think companies will need to innovate. If I talk about, let's say, Zomato, you want to talk about Zomato, right? Zomato, sometimes competition does well, right? So Zomato was a content company or discovery company till 2014. When Swiggy
Right.
came, it actually helped Zomato figure out its monetization model, right?
Mm-hmm.
It was operating from 2008, six
Right.
years. It could not build a solid monetization. Today, if you see Zomato's revenue, I don't have the number at my offhand, but my estimate is a large part of the revenue would come from delivery, right? And today
Right.
Zomato is able to do this despite not being profit, right? So
Mm-hmm.
sometimes competition would bring best among entrepreneurs. Overall, I think having the competition is good. Sometimes having an excess capital would stifle the competition as well, because capital would become differentiated. So all these things will sort of play out, and I'm damn sure if VC see strong entrepreneur, even at pretty late stage, they would back the entrepreneur to create something meaningful in that particular vertical.
Right.
So
I mean,
going to stay.
interesting. Then we're towards the end of the conversation. We'll try and sort of wrap up. I still have like a laundry list of questions, right? But I think I'm going to sort of prioritize the next next two or three of them, right? Um, Devendra, how important has become? So we always hinged on creating a financial model, right? For many startups, right? And I'm particularly talking about a post COVID environment, right? Like I said, right, it's a difficult ecosystem that we are in right now. When your CAC is going through the roof, it's not a very predictable environment. Everybody is essentially participating in the same ecosystem, right? How important is it to have so earlier? And my thesis was, and my sense was, when I used to talk to, and I still talk to many founders, right? A financial model that you're creating is a reflection of how you are looking at the market, right? It might not necessarily be true, right? I mean, there still be variances, right, in how your performance numbers are. But I think how clear you are in terms of each of the aspects is really sort of, it's a reflection of your mindset, right? But today, it's a different ecosystem, right? I mean, nobody very clearly knows. I mean, anything that we did in a pre-COVID era, right, is not necessarily relevant. Right? Is only relevant to a certain extent, right? Numbers are not necessarily very clear. How important does it become, to have a certain financial forecast, right? I mean, how important is it to have? I mean, is a larger level understanding important today, or you have to have certain parameters which have to be very clear, saying that this is how it's going to play out, right? That visibility, how important has that become in an environment like this, right? When you're especially out there to raise capital.
I would say financial model has always been extremely critical, and
Sure.
it will always be. In fact, I work on both sides. I work with entrepreneurs who are extremely savvy about this thing. I work with entrepreneurs who are not at all sorry. They'll
Sure.
actually say, "Hey, yeah, I'll tell you my story. I want you to build, right? I can't predict the future, right? And
Right.
obviously, we have to put something down, right?
Right.
My sense is financial models are very important because they discipline the entrepreneur. They allow their wild sort of thought process to come down to reality,
Mhm.
and they need to predict it. Having said that, it's very very hard to predict future in pretty
Right.
early stage. So
Right.
financial model also come down to the company whether PMF is established, right?
Mhm.
PMF, product market fit, where CACs have been sort of stabilized, where markets have been sort of stabilized, right? So it's actually difficult. What
Mhm.
founders often tend to do, they underestimate their cost or CACs by like large degree, and they
Right.
overestimate their monetization and sort of revenue. So
Right.
my message to founders is that they need to take financial model seriously, and the people who take financial model seriously, the company I'm talking about, once again, they have, right? They have met their numbers 4 year in consistency. I'm not seeing in a single tech company that is happening, right?
Right.
4 year they have either met or beat their numbers consistently, right? Like
Right.
every year they meet or beat their number, right?
Mhm.
And honestly, if the founder finds any slightest thing wrong, right, he sit with me for 2 hours and he would try to correct it. Hey,
Right.
why did we sort of, let's say, this thing, right? So
Mhm.
he's not afraid to sort of even make the changes as well, right?
Mhm.
So I would say founders who can execute very well, who can build team well, and also a discipline about putting their thoughts down in terms of financial numbers in a financial model, and also be disciplined about it, actually would have much sort of larger success. Having said that, I won't take away anything from the founders who don't do that. because what they would do, they would supplement it by hiring a smart sort of CFO or a co-team member or a co-founder
Right.
who
Right.
take care of that aspect. So overall is critical element, but at early stage, sometime just to answer this thing, sometimes you're not able to predict future beyond 6 to 12 months. So 6 to 12 months, you should know what you are doing. Beyond that, the number might say XYZ. It may not achieve, at least in early stage ecosystem, till you are pretty early stage seeds, series A, even series B. That's okay. Later you are like series C, series D. The questions
Fair
obviously
enough.
will become more sort of demanding from the investors.
Correct. It has to be more stable, and I completely understand where you're coming from, right? Devin, what has Zomato done very quickly, right? What has Zomato done to the Indian startup ecosystem, right? I mean, I think everybody's been extremely excited about it. I'm sure I've been very excited about it, right? The possibility of an Indian startup, going out and getting listed, right? And investor participation being so amazing, right? We've talked about it forever, right? We've talked about US based markets, right? There was a huge conversation which was happening around 16, 17, 18, right? Where there was essentially startup want to relocate to, say, a more listing friendly country, right? So for example, Singapore became a destination, right? A lot of them are getting listed in Delaware, right? Because of course the terms and conditions and clauses, right? And the ease of getting listed, right? But I think this has been a watershed event in many, many ways. I mean, this is something that I've spoken with many investors, and I think everybody kind of agrees that this is a watershed event, right? This brings in a very different kind of an enthusiasm and a confidence that eventually a company which is not necessarily profit making can actually go out and get listed now, right? And Indian investors will provide adequate liquidity, will buy into that, the longer term thought process, which it's going to require, right, to get to a certain point, right? Especially in a market which is transforming itself, right, and which is a large shift. How do you see that, right? This event, and how do you think it's going to impact the Indian startup ecosystem? And I'm largely asking you because you are day in day out talking to, you're representing many companies. You're talking to many investors, right? How is this event? What kind of an excitement is this event leading into?
Ashu, Zomato is a literally a watershed moment sort of in Indian startup ecosystem. In fact,
Sure.
I would call the event as literally historical. I'll take you
Right.
back in my starting days at Dexter when I was building Dexter in Jaipur.
Right.
Okay, I would go out and meet, like there would be forums, right, where all the top notch entrepreneurs of Japan would sit, and I would actually try to
Right.
educate them. Ki, hey, this is new phenomena, right? Like startups which are not this thing, and I was a young guy, right? Like they will say, ki, hey,
Right.
this won't survive, right? If a company is not making profit, it doesn't make sense, right?
Right.
This is a fad. This won't survive, right? A company like Zomato listing, people participating, retail investor participating, that is literally change phenomena. It
Right.
would impact multiple ways.
Mm-hmm.
If you talk about the 91, where companies like Infosys become this thing, before that, people will chase government job.
Right.
People will tell the next generation, hey, you need to get a government job because government is secure.
Right.
Private job, sorry, that's not secure, right? In my generation, people were running after, we would prefer private jobs over government jobs, right?
Right.
Same thing 10 year, 15 year back, if a person would join startup at lesser than second the market salary, that the parents would say, hey, why the hell you're joining startup, right? Or in fact, let's say I'll talk about very interesting thing, right? The marriage market. One of the
Mm-hmm.
excuse that was given at the time appraisal is, hey, look, I need to get married, right? I need to get market
Right.
salary, right? So that would change, right? So a lot of things will change in Indian context, at least social economic level,
Right.
where startup would become mainstream. Parents would become more supportive of their next generation to start a startup. The people who are HNIs who wanted their son, I'll give an example, right?
Mm-hmm.
There's a young kid. I'm not too sure I name him. I shouldn't take names, right? He was building a very very interesting company in Jaipur, Street Jumper.
Mm-hmm.
Phenomenal company, doing extremely well. He came from a pretty well-to-do family. I
Mm-hmm.
sat with the kid. I wanted to invest in his company, right? I sat with the kid. I sat with the father. Father was not convinced. He wanted to send the kid to sort of, let's say, be school fees and it did, right? That did not happen. I think a lot of those events would change in going future, right? Because not just kids, right? The parents would believe in the startup story, and they would be more, I would say, more benevolent to allow their kids to
Mm-hmm.
pursue their dreams for longer. So
Right.
that pull that used to come from families, ki, hey, why you are doing it? This doesn't make sense to us.
Right.
That would continue far longer, I would say, and that sort of would change the entire ecosystem, I would say, completely. We see more participation from entire economy in terms of ensuring that there are more entrepreneurs, there are more people
Right.
who are working in startup ecosystem.
Interesting. Devin, very quickly, right? Which are the upcoming sectors that you are, you're extremely excited about, right? Uh, I think a quick one on that will help.
Yeah, so Look, anything which is partially impacted by digital economy is a sector where I think that would sort of continue to do well. So
Uh-huh.
my sectors where I think things will happen pretty well longer time would be edtech, gaming, B2B commerce, driven through digital economy, right? Social commerce. So all those sectors, in my opinion, will continue to do well currently and foreseeable future as well.
Interesting. My last question, right? And which is actually more an advice to many founders who are going to watch this, right, and are going to listen to this. What are the broad pointers that they should keep in mind, especially in a post-COVID environment, right, when the market has become just so much more dynamic, right, so much more efficient, very transparent, right? I mean, and that's something that we kind of talked about in the secondary market, right, as a practice. Transparency, availability of information, right. And I think we are essentially in that ecosystem, right? So, what are the broad pointers that many founders should sort of take under consideration? We've talked about a few, right? And how I wish this conversation go on. But what are some of those pointers that the founder should look at very sharply, especially in an early stage ecosystem, right? When they are, say, at a seed level, pre-series, series A, right? What are some of the things that they should prioritize, look at very carefully?
Sure. So I think one of the first thing is having absolute clarity what they want to build.
Sure.
Second, knowing what the customer need. Third, how those customers' needs are being served through existing solution and how
Mhm.
their solution is going to different. How the
Right.
solution is going to be materially superior than all the existing solution combined together. Okay,
Mhm.
those things plus having clarity what are the current team, which is entrepreneurial team is building on the table,
Right.
the skills or complementary skill that current team sort of brings, and what are the future path looks like 12 months, 18 months down the line. They don't need to look maybe 4 year down the line, but how
Mhm.
they are going to solve the challenges which are coming down to 12 to 18 months. Are
Right.
they going to solve the challenges through raising capital? Are they solving the challenges through getting excellent people on the board, not by paying them like their market salary, but just like selling their vision to those founders or those
Right.
potential co-founders or core team members, and inviting them part of the journey, and
Right.
and exactly how sort of let's say doing that. And lastly, I would say every founder who become entrepreneur should have complete support of their family, because
Right.
family is essential, very critical important. If you become an entrepreneur and you have this worry ki, hey, my family is getting worried, that's not a ideal emotional state to build a start. So that's the last thing I would say to the entrepreneurs. Having those things would be pretty critical for early stage entrepreneurs to continue to build the company. And I'm sure uh, we would see more and more entrepreneurs, more and more people become entrepreneurs now.
Interesting. Devin, it was a pleasure to have you. I mean, how I wish this conversation could go on. I mean, I think, when you're talking about this particular bit, right, which is, more about fundraising, capital raising, right, ensuring that, you strategize it right, you're getting the right mix together, right. I think this is a conversation that can go on, right. I mean, this is like a never-ending conversation, and I'm sure you would agree, right. But I think
Absolutely.
I'm going to reserve a lot of this for our next conversation, and hopefully we're going to have it soon, right, subject to your availability. But thank you so much, Devendra, for taking the time out. It was a pleasure to have you with us. Look forward to having you with us very soon.
Thank you, Ashu. It was a pleasure speaking with you, and look forward for our next conversation.
Thank you.
Thank you.